Welcome to our channel. Today we're diving into the world of index funds. If you're looking for a simple, low-cost way to invest in the stock market, this video is for you. We'll cover everything from what an index fund is to how it works, its advantages, the different types available in India, and most importantly, how you can start investing in them today. Whether you're a complete beginner or have some investing experience, this video will equip you with the knowledge to make informed decisions and grow your wealth over the long term. So let's get started. Imagine trying to bake the perfect cake. You could spend hours searching for individual ingredients, figuring out the right proportions, and hoping it all comes together. Or you could use a pre-made cake mix. It has all the ingredients in the right amounts, and all you need to do is add a few basics and bake. That's essentially what an index fund is, a pre-made investment mix for the stock market. Instead of picking individual stocks, which can be time-consuming and risky, an index fund invests in a basket of stocks that make up a specific market index, like the Nifty 50 or Sensex. Think of an index like the Nifty 50 as a collection of the top 50 performing companies in India. When you invest in a Nifty 50 index fund, you're essentially buying a tiny piece of all those 50 companies. This means your investment performance is tied to the overall performance of those companies. Now here's the beauty of index funds. They're designed to match the performance of the index they track, not beat it. So, if you're looking for a simple, low-cost, and effective way to invest in the stock market, index funds are a fantastic option. Let's break down how index funds actually work. Remember, they aim to replicate the performance of a specific index like the Sensex, which tracks the top 30 companies on the Bombay Stock Exchange. To do this, the index fund buys the same stocks that are included in the Sensex and in the same proportion. So, if Reliance Industries makes up 10% of the Sensex, the index fund will also allocate 10% of its portfolio to Reliance Industries. This mirroring of the index is what makes index funds passively managed. There's no fund manager sitting there making daily trades based on market predictions. The fund automatically adjusts its holdings if the index composition changes. For example, if a company is removed from the Sensex and a new one is added, the index fund will sell its shares in the removed company and buy shares in the new one to maintain the same weighting as the index. Now, the price of an index fund, also known as its net asset value (NAV), is calculated at the end of each trading day based on the value of the underlying stocks it holds. So, as the prices of the stocks in the index fluctuate, so does the NAV of the index fund. Now that you understand how index funds work, let's talk about why they're such a popular investment choice. Here are some key advantages. First and foremost, index funds are incredibly cost-effective. Because they're passively managed, their expense ratios, the annual fees charged to manage the fund, are significantly lower compared to actively managed funds. This means more of your money is working for you, compounding over time. Second, index funds offer instant diversification. By investing in a basket of stocks across different sectors and industries, you're spreading your risk. This is crucial because if one stock or sector performs poorly, it won't significantly impact your overall portfolio. Third, with index funds, there's no fund manager bias. You're simply tracking the performance of the overall market, which has historically trended upwards over the long term. Fourth, index funds are excellent for long-term wealth creation. By consistently investing in index funds over time, you're benefiting from the power of compounding. The world of index funds in India is quite diverse, offering a range of options to suit different investment goals. Let's explore some of the key types. Firstly, we have broad market index funds. These funds track major indices like the Nifty 50 or Sensex, providing exposure to the largest and most established companies in the Indian market. They're a great option for investors seeking broad market exposure and long-term growth potential. Next, we have mid-cap and small-cap index funds. These funds focus on companies with smaller market capitalizations, which have the potential for higher growth, but also come with higher risk. They're suitable for investors with a higher risk appetite and a longer investment horizon. Then there are sectoral index funds, which concentrate on specific sectors like technology, healthcare, or banking. These funds allow you to capitalize on the growth potential of particular industries. However, it's important to note that sector-specific investments can be more volatile. We also have international index funds, which invest in indices of foreign markets like the S&P 500 in the US. Investing in index funds is easier than you might think. Here's a step-by-step guide to get you started. First, you need to choose a platform to invest through. You can invest in index funds through mutual fund platforms like Grau or Zeroda, banks offering investment services, or directly through the websites of asset management companies, AMCs, like HDFC AMC or SBI Mutual Fund. Once you've chosen a platform, you'll need to open an account and complete the KYC Know Your Customer process. This typically involves providing your PAN card, Aadhaar card, and bank account details. Next, select the index fund that aligns with your investment goals and risk appetite. Consider factors like the index-tracked expense ratio, historical performance, and the fund house's reputation. Now you can invest in the chosen index fund through two primary methods: lump sum or systematic investment plan, SIP. Lump sum investing involves investing a large amount of money at once. This method is suitable when you have a significant sum available and want to maximize your exposure to the market. On the other hand, SIP allows you to invest a fixed amount of money at regular intervals, typically monthly. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more investing tips. Let us know in the comments if you have any questions or need recommendations based on your specific goals. So, start your index fund journey today and pave the way for a secure and prosperous financial future.